Hello and welcome. On today's episode, we're going to be taking a look at our takeaways on turnkey real estate opportunities and Paula's insights on building a team, both of which were really two perspectives. I think we have some feedback to add from our community. On top of that, we actually are going to be offering a meditation courtesy of J.L. Collins on what to do with volatility in the stock market.
The dulcet tones of Jim's voice will soothe you to relaxation, that's for sure.
That's it, man. Welcome to the ultimate crowdsourced personal finance show. This is your Friday Roundup.
You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, super excited to dive into this episode. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I'm doing quite well. Yeah, how are you recovering from our CrossFit workout this morning?
Yeah, I mean, it's pretty good. I mean, thanks to you, I've started to build CrossFit into a little bit of a cadence of my life. I have this aspirational goal of going 3 days a week. It's actually never happened. I'm kind of astonished by that. I have this goal of 3 days a week, but I'm so devastated by the time that I finish any one of these workouts that it usually ends up being 2, and I limp my way through the weekend. I'm like, well, I'll do better next week. But I love it. It's kind of like building a structure. It forces you to become a different person. And my thing is, I just have to show up. If I can just get there, if I can just focus on getting there, the rest of it takes care of itself.
Yeah. And in fairness, 100% of the time when I say, I'm going, Jonathan, come, you'll be there in a heartbeat. You work yourself crazy there. I've been blown away. So keep on showing up.
Well, you gave me that compliment a couple of times, and there's almost a little small element of imposter syndrome every time you said it. And I mean this in the best possible way, in that, like, when you said, wow, well, you're really bringing it, you're working your tail off, why, at these particular workouts. I'm like, well, that's not really me. I'm kind of like, I'm the guy that's looking for that optimized lane to do the bare minimum possible to get the maximum results. So to find out that, like, objectively from external looking in, it's like, hey, I appreciate that you are stretching yourself and you can tell you're uncomfortable. You're leaning into it consistently. I was like, that is a genuine compliment. And I feel like I'm becoming a better human being as a result of realizing the compliment that you're giving me. Like, that's not me. I think I must have you fooled, but slowly over time, I'm going to focus on becoming that person.
Yeah, it works for me. It certainly looks like you're working your tail off. So very impressive. And Jonathan, I've actually been seeing a bunch of articles in the major newspapers about FinCon.
Really?
Yeah, I've seen 2. And actually, JD Roth posted about this on his Facebook page about someone saying that FinCon needs to be more political, which I thought was very odd.
More politics. That's what I need.
Right. Seriously. And, as you well know, we keep Choose FI as a politics-free zone. This is a nice, happy, safe place. So we're certainly not going to be talking about that. But I just thought it was an interesting thing if somebody out there wants to Google it. But the other one that I saw just yesterday by a syndicated columnist, Chuck Jaffe, who I've seen writing all over the place. It was actually syndicated in our local paper. It was titled Gaining Choice and Not Early Retirement, Your Real Goal. That piqued my ears up here because that's what we're going for. And he starts the article with, it's all about the acronym. He said, that's why a 20-something member of the, quote, FIRE movement, which stands for Financial Independence Retire Early, told me last week at FinCon 2019 that I, quote, don't qualify as FIRE. And I'm thinking, what on earth is going on here? This is not what we talk about with FI, right? We don't even focus on the RE because it is about that gaining choice. And Chuck continues here to say, I'm not naming him because I actually admire his push to get out of debt and take control over his financial life, even as I couldn't understand how anyone could suggest I'm, quote, not FIRE. Financially speaking, look at any scale designed to say who is prepared for retirement, and the math in my retirement and investment accounts shows me as being ready to quit now. And I'm not retired because I love my job and don't want to retire. This is, speaking exactly to what we talk about here.
He's speaking to my soul.
Right. I don't particularly want to be FIRE, he said, but I wish people understood that retiring early shouldn't be the goal of achieving financial independence. The real goal is gaining choice. As I told my daughters when I started teaching them money lessons at age 3, money gives you options, choices, and control. My kids are nearly the age of that FinCon blogger. To date, they've avoided the problems he brags about overcoming. And he actually goes on to say, which is funny, none of the FIRE members I have met who, quote, retired early have actually, well, retired. They may have quit traditional day jobs or left the corporate world for something less structured, but they're active in their communities and in life, often teaching or coaching, helping others learn financial responsibility, and volunteering, taking jobs or projects that they find meaningful and more. In fact, these more experienced FIRE members would suggest that I am one of them, despite no plans to retire, because I control my destiny rather than being controlled by the salary from my day job.
I feel like Chuck is a better messenger for financial independence than we are, Brad.
I think so, right? I mean, that is exactly how we view financial independence. And I was blown away by reading this article.
All right. So MK, can we reach out to Chuck and see if he wants to come on the show? She's giving me a nod in the affirmative. We can make that happen. We'll reach out. But honestly, this is it. I think we've been trying to communicate this very close to inception, if not right there on day one. This is about options. There's no downside to having more options in your life. And financial independence, that's what it gives you. And I don't think any of us, I mean, this is the heart of this. I want everyone to be able to have the choice to walk away. I don't want everyone to walk away. I want everyone to be able to have the control that when pressures of life are coming at them, they're able to make the choices that are in their best interest, not just based on what the money is telling them to do, but they're able to look at their life and their values and say, this is what I want to do. It's a proactive, intentional choice, not a reaction to life's overwhelming pressures. That's what financial independence gives you. Retiring is a interesting quirk of that choice, that you can do that. And many people do, but it's not the end. It's not the end all be all. Rather, it's almost a natural pivot than when you made these choices at 17 or 18. For many people, I think like 70% of people express some level of discontent in the current career or structure or exact job that they find themselves. If you get to the point where money is optional, working for money is optional, you're probably going to make some decisions to realign your time with whatever activities it is that you want to be doing. And I think often those activities will be in the form of a job. It's just not going to be in a job that like destroys your psyche, feels like you're just slowly driving or commuting your way through traffic to your grave.
That's quite a visual there, Jonathan. But no, I certainly agree. And yeah, I mean, I think Chuck hit it on the head here. I mean, I know maybe 1 or 2 people who would consider themselves fully retired after reaching financial independence. And even those 2, they're still doing things. They've
just changed what retire the word. So we're saying it's not about retirement. They're just saying, well, retirement doesn't mean what you think it means. Right. So it just depends on which way you want to combat it. Some people, and to this point, I love that Chuck is like standing up and saying, look, this is what I want to do. Yeah. Don't tell me that I'm not part of the community. Yeah. This is what I want to do. And so I think the positive here is that this is a massive tent, and finding the paths that people have chosen, finding the jobs that people are doing that genuinely light them up. There's some value there, I mean, if honestly, what if what we're combating at its heart is this statistic that says that 70% of people are unhappy in their jobs? Maybe this is all at some level is all about helping you get to the place where you are just doing stuff, doing work, doing a job in a profession that just thrills you. But before, you just didn't have the confidence to pursue it. And tied to this, Brad, speaking of jobs that you love that maybe don't show up on a top 10 jobs of 2019 Google search, interestingly enough, someone was commenting in the Facebook group, hey, I was down in this coastal city with my family on vacation and I saw the coolest side hustle ever. There was an individual that was helping people learn how to build these amazingly epic sandcastles. You know how like when you go to the beach and you're trying to like build something just being like a circle and you dig a moat? Some people can take that to the next level and you get full on castles with spires and banisters and all this crazy stuff. It's nothing I've been able to pull off, but there's individuals that have like literally dedicated their lives to this art form. And there was a very interesting response, serendipity, if you will, on that thread.
Yeah, Jonathan, this blew me away. So I'm reading this post on Facebook by Tim, and he said, I just saw the coolest side hustle ever. I'm on South Padre Island, Texas. A guy on the beach teaches sandcastle building classes. He's got a bicycle with a trailer loaded with shovels and pails. 5 customers were hard at work. I was definitely impressed. And I saw this and my mind almost exploded, honestly, because I'm like, yeah, that's my cousin who I grew up with. And how is this possible that Tim in a Choosify group of 52,000 people post this random job from this random place, this amazing side hustle, and it's my freaking cousin. It was, I mean, the small world of that is beyond belief. So he actually said, he gave me the guy's number from the business card, and I looked it up, and lo and behold, it was sandslave.com, and it was Dennis Barrett building sandcastles in South Padre Island, Texas. I mean, what are the chances of it?
I mean, we're like, I don't really keep track anymore, but we're approaching 300 episodes, and I've never heard of your cousin that is following this path. Like, why does it take 300 episodes for you to talk about literally the coolest person in your family?
Yeah, he definitely is the coolest person in the family. Yeah, I mean, he's lived this unconventional life for decades now. And as long as I've known it, he's been doing these kind of crazy side hustles. As it was explained to me, and I have to fact check this in the family, but he's really super intelligent guy, and he created some type of like oil measuring device. Again, as I understand it, he's been living off of royalties and such from that, and just living this amazingly exciting life in this beach community in Texas. You know, when he came up to visit us in New York about 15 years ago, we all went down to Robert Moses and built these like insane sandcastles, and it was just the coolest thing. And yeah, again, super small world story that Tim mentioned. Saw this random guy on the beach with the coolest side hustle ever, and it was my cousin.
Wow. There's something there, man. I mean, just to be able to thread this needle, you often hear the term attached to creatives, you know, starving artist, if you will. You know, you can go get that philosophy degree, you can go get that liberal arts degree, but just know that, you know, it's, you know, what if the pursuit of financial independence following this path gave you the options to literally reclaim decades and decades of your life to put back into your passion? So instead of trying to profit from your passion right out the gate, many of us have already chosen a path and are on that path. And instead you optimize that and you use that to craft your quote unquote escape plan. And you find something that you want to run towards, but you do it in a fiscally responsible way. I think that's what this intermediate time period, this pursuit of financial independence gives us. It gives us a way to plot our destiny out. And many times, I mean, if you can do anything and you don't have to worry about what the money is telling you to do, it's very, very rewarding, and it allows you to lean in a way that I think when you're scared about how you're going to keep the lights on, how you're going to do whatever, you just are unable to do with the same level of vigor and enthusiasm. And so, extreme example, what your cousin's doing, but that is amazing. So I had a it's kind of a stretch, but I'll go ahead and talk about it now. Since we're talking about real estate with this particular episode, I did sell my house. So
congrats.
Yeah, thank you. And so all of it is finished, and I had a pretty significant amount of equity that I brought out of the sale of the house. And as I was sitting on this equity, trying to figure out how to deploy it, deploy my capital, I realized that this might be a useful thought exercise for people in our community, because many people in this community and all around the world at some point in their life will receive some form of windfall. Now, in my case, we're just talking about equity from the sale of a home, but many people will have equity in the sale of their home. It's been appreciating over time. They've been paying down the balance. Maybe they move from a high cost of living area to a low cost of living area. Maybe they receive some form of an inheritance. Maybe it's a massive inheritance. Maybe it's just a small one. But for many people, at some point in their life, they will suddenly receive a lump sum of money that is multiples of anything that they have had just sitting in a bank account up to that point. And when that happens, panic strikes, because you don't want to do anything stupid, right? You don't want to just blow it all. You don't want it to disappear. You want to be responsible with this, and you want to deploy it in a way that really sets you up for the best possible success down the road. And so I was thinking through that thought exercise, and I thought maybe it might be worth it for us just to spend a few minutes talking about how we would mentally go through that exercise. And for the sake of this example, I was thinking maybe it's a big number, but let's just use $100,000 as kind of, you have this $100,000 windfall because you received this inheritance or you sold the house, whatever it may be. For the first time, suddenly you have $100,000 and you want to make sure that you do, the right thing with it. Would you like to explore this thought exercise with me?
Yes, please.
All right. So let me tell you my thought process. Initially, it was, what do you need to play catch up on? So for the individual, maybe they weren't going to be maxing out their 401k this year. They weren't going to be maxing out their HSA. It's kind of going through some of those pre-tax buckets, assuming you're in a moderate to higher tax bracket. You're maxing out all those pre-tax buckets, your 401k, your HSA, if you're eligible for it, maybe your Roth or traditional IRA, taking care of those simple buckets. And then once you're done with that, then you're looking to think, what else can I do? Anything come to mind?
I think you're right. That would be my first thought process, right? Go through, can I max these things out? Does that give me a tax deduction in the current year? Because clearly there's value there. We obviously always talk about control what you can control. And to a large degree, you can control your tax rate and ultimately your tax liability by maxing out these pre-tax buckets. Another thought, for me at least, the next two options would be potentially paying down a mortgage and investing in the stock market. So for us, we generally, in very general terms, believe in low-cost index fund investing. Those would be two things that I would consider. Now, obviously, everything's situational, right? So in your case, you're talking about getting equity from a home. While it shouldn't necessarily prejudice you for, hey, maybe I should put this into my new home, I'm sure there's some thought process there that instead of being optimal for the math, you might just think like kind to like kind, and that might influence you. So I don't want to put words in your mouth, obviously, but I think those would be two very logical options.
Very logical. I did not feel that pressure. So if I had not hit that 80-20 threshold and I was still paying PMI, I probably would have paid that down. So that was gone. With that, being out of the way and being this early in my investing journey, I don't really feel a huge draw to drop that significant amount of money on the equity in my home, especially when we're talking about 10, 15, 20-year time horizons. So with that in mind, I'm looking more at, my taxable investments. I'm pretty happy just paying my mortgage as is. I have a low, 4%-ish interest rate on my mortgage. I'm just going to kind of ride that one out. And I'm going to take it personally. And I think I'm going to be taking the difference and putting it in either a emergency fund and having a high yield emergency fund. So like a savings account. We talked recently in past episodes about like a CIT bank. And there's a couple out there. Ally is another high yield savings bank. We're big fans of CIT. I think they have one of the highest rates out there right now. It's like a 2.2% interest rate at the time of this recording. There's a few contingencies on how you go about getting that interest rate. It's called the Savings Builders, the one that we've talked about on our show before. And basically, in order to get that 2.2% year over year APR, then you need to be contributing like $100 a month, or you can have a lump sum of $25,000. So I was thinking of fleshing out just the full, taking a portion of that and just dropping it in there to hit that other requirement. I was talking to CIT about this with Ed. I was talking to them about how it would actually work. And they were telling us that in order to get that, 2.2% APR, they're actually really flexible about how you're funding it. Like, this is interesting. I was like, really? You guys are cool with that? I mean, but basically they said, we want you to get the 2.2% savings rate. And the big thing is we want you to be using it and feel comfortable with this account. So in order to make sure that you're having that, let's say there's a month where you can't drop $100 in there for some reason, and you're not over that other threshold, but you want to make sure that you're getting that 2.2% yield. You can actually take out the $100 and then just redeposit it that month, and you will still get credit to meet that. So they are going out of their way to lower the barrier here. So there's no reason that you'll ever not get your interest, that they're guaranteeing you. So it's a pretty cool program. They're pretty flexible with it. I like the idea that they're encouraging, long-term savings. And at the same point, they're making it not particularly cumbersome to get that higher interest rate. There were some banks that they will make you jump through the moon to get this interest rate, knowing that many people will fall off the wagon in short order. It looks like CIT is going out of their way to make it pretty simple.
Yeah, and Jonathan, I'm at Ally Bank's website, and yeah, they don't have any of those requirements, but they have a 1.9% interest rate. Obviously, you have to know yourself. It's pretty easy to reach those requirements on CIT, especially if we're talking about a windfall, but obviously know yourself. If you're interested, we do have a link at choosify.com/CIT.
Now, the remainder of this equity that I'm doing, so after I've taken care of all my pre-tax buckets, I've taken a look at that for the year and make sure they're all taken care of. After I've taken care of making sure that emergency fund is fully funded and that I'm very happy and satisfied with that, my next thing is my taxable investments. Think about your brokerage accounts, Vanguard, Fidelity, Schwab, M1 is another one that we talk about. And for me, I have two things going on that I'm kind of interested in. One is Vanguard is a platform that when I have large sums of money, I usually, if I'm going to be dropping something, that's a platform that I'm doing it on. And so with Vanguard, I will roll, I don't know, maybe $10, $20, $30, $40,000 into Vanguard. And now you're saying, all right, the rubber's hitting the road here. How do I feel about dollar cost averaging versus lump sum investing, right? How much do I believe this? So if you're looking at dropping $30, $40, $50,000 into the market. Do you want to do it all in one day, or do you want to spread it out? And my biggest takeaway is do whatever allows you to comfortably get in the market and get in the market as quickly as possible. So if that looks like you just tricking yourself and dropping in, 2,000 at a time, 5,000, 10,000, 20, whatever you can comfortably do, get that in and then make that decision the following week and the following week. And that's kind of like my psychological thing to, as opposed to, is this the top? I can't afford to invest it all at the top.
Yeah, that's a realistic thought. People get scared of this. I know for me, investing psychologically is the hardest part, right? Like I get caught up in my own brain, and I think a lot of us do. So if you read a bunch of articles, it seems to suggest that lump sum investing, putting it all in as quickly as you possibly can, is the most mathematically optimized version. But I got to be honest and say, I do not do that, and I will not do that for my own brain. Okay? So you have to know yourself. This is really important. What I do like to do is set a plan. So if we're talking 100,000, then set a plan that you're comfortable with. All right? I want to put 5,000 in every month for 20 months. And I know many, if not most, places like Vanguard, Fidelity, etc., allow you to set up automatic investments. So I would take my brain out of it. I'd have this 100K in an account, and I would just pull out, like I said, automatically set up once $5,000 a month for 20 months on the 15th, or maybe I do 10,000 a month for 10 months. But I can tell you for damn sure, if I leave it up to me and I leave it up to, looking at what is the market doing that day, or like Brandon, the mad scientist, said way back when, I think episode 17, he was looking for, some insane stuff like hockey numbers and other bizarro stuff like this. We all get caught up in this. We all get caught up in our own heads, and you need to take your brain out of it.
So the nuance here is, as me kind of saying, here's what I would do. I'm saying this as someone that's in my early 30s. Now, someone that, and also someone that is self-employed, that has variable income. Those are like two factors that are unique to my particular situation. But you need to look at your particular situation. So, if you're going to be needing this money within a 5-year period of time, does that change things slightly? Does that change the emphasis between paying down your mortgage versus putting it into a taxable account? I think there is some real benefit to when you actually no longer have income coming in, that you don't have that mortgage anymore. That mortgage is gone by the time that you retire. I think the question, many of us get fixated on, do I pay off my mortgage or invest? But we kind of forget the analysis. Well, who are we talking about? Who is this individual? As someone that's in my early 30s and has a pretty long investing timeline, I'm not super worried about, that 4% interest rate over time. I'm pretty confident that I'm going to do better than that by investing in the stock market. But if I'm retiring or I need this money in a much shorter period of time, there is some degree of wanting to preserve the capital that you have. You still want to get some growth, but you're not as committed or fixated on growth as much as you are on locking down what you have and making sure that you have a way to provide for yourself and for your family. That changes the calculus, and that you can make a very compelling case that when you leave your job and you no longer have regular income coming in, it would be huge to not have a mortgage. It would really give you an ability to buffer the storms in the way that having that extra, monthly bill that's hanging over your head, that's maybe $1,000, multiple $1,000s a month. That's freedom and flexibility if you don't have that. So I think when you hear us talk about, and this is kind of the heart of it, when you hear us talk about how pay off your mortgage versus invest, and we lean towards investing in most cases, you have to think about your timeline in the context of that conversation and where you are on this journey.
Yeah, Jonathan, I totally hear you. And I actually wanted to start up a new little segment here. I didn't tell you about this beforehand, but I want to do a little 5101 refresher. There's so much information over these hundreds of episodes, and someone coming in right off of the street and having never heard all of those episodes, I'd love to have just like a little tidbit, just even a minute or two, like FI 101 quick hit.
Okay.
So for me, let's go back to the way beginning and just say, for me, one of the most important things you can do as far as getting a 100% return on your money is see if your company has a 401k match. This is one of those absolutely foundational items for FI and investing generally. So what happens, a lot of us, hopefully not in the FI community, but many people in general are literally giving up free money. What happens is their employers, if they put money in, let's say the employer gives a 100% match on the first 3% of money that you put into your 401k. So how this works conceptually is you take 3% of your salary and you defer it into your 401k. All right. So you get a tax deduction for that, which is wonderful. And your employer literally matches. Again, in this scenario, they're matching 100%. Every 401k has different terms and conditions and such. So you need to look for your own employer. But in this case, they are taking 3% of your salary and dumping it into your 401k for free. So that is quite literally a 100% return on your 3%. That is free money. It is in essence part of your salary. And tens of millions of people give that up for no reason, just because they are unaware. So at the very, very, very least, you always have to put money into your 401k to get the full extent of that match. Now, our preference would be that you put as much as you possibly can into your 401k, because again, it goes back to control what you can control, and you get that tax deduction in the current year. But at the very, very least, get that match.
Yeah, I love it. I feel like now I just want to do a full Fi 101 kind of segment here.
How about every week? We can do a little, or thereabouts. We'll
All right,
do a
so
little
next
Fi
time,
101.
can we talk about like expense ratios and how to pick a fund?
That was my next one.
Nice. All right, write it down. Next week. So, all right, for people that want to skip ahead, though, we do have a Fi 101 course. It's currently, we're going through beta on it, and we're rolling it out to some of the local groups to give you a resource that you can share with friends and family members. It's going to be, I think, a 6-week course that comes with companion workbook material. If you want to do that, I should say it's completely free. Just go to choosefi.com/Fi101, choosefi.com/Fi101. All right, now, Brad, I think you teed us up to do a meditation on this episode today. Now, give us more details on this.
So this was very interesting. I saw on J.L. Collins' website a couple of weeks back a guided meditation for when the stock market is dropping. And this actually showed up in my RSS feed on the site Feedly. And I actually thought that it was completely satirical and there wasn't a meditation. So I'm embarrassed to say that I didn't click over to it at first because I just thought it was a total joke. But then we met...
Like total joke as in funny joke.
Yes, as in completely funny joke. I wasn't sure there was an actual meditation, but then we met Elizabeth Andrews at FinCon, and we actually had her on a voicemail a couple of weeks back. She called in on her birthday. She had actually just been to the recent Chautauqua in the UK, and I guess this was kind of her idea originally. Yeah, she said she came up with this idea, got the project rolling, and got Jim excited about it. And we all know how amazing Jim's voice is. And Jim's daughter, Jess, who we met at Chautauqua last year, she did the video production. But I'd really, really like to play this meditation right now. I just think it is phenomenal. And it just gives you that little bit of comfort. And I never tire of hearing Jim's voice. So even though they did a video of it and we can link that up in the show notes, let's do the audio now.
So Brad, before I hit it, let me just do the setup for this, which JL Collins, his website, jlcollinsnh.com. That website is a phenomenal resource, by the way, for introducing the stock series. If you haven't yet checked that out, you should go to the site this week as one of your action steps. But the description of what this meditation is, the market is plunging. You're starting to panic. You want to hit the sell button. Don't! Tune in to this relaxing meditation and let the soothing voice of J.L. Collins help you embrace this wonderful market cycle. Wow. All right, let's go ahead and tee that up.
A Guided Meditation for When the Stock Market is Dropping by J.L. Collins. Let's begin. Find a comfortable place to sit. Breathe in and out. In and out. Settle into your space. Now, slowly close your eyes, or perhaps hold them half open and unfocused. Breathe in and out. In and out. Focus on the sound of my voice. Breathe in and out. In and out. If you are listening to this, you are working on building your wealth with regular investments into VTSAX or a similar total stock market index fund, Or perhaps you are retired and have a portfolio balanced between VTSAX and VBTLX, or a similar total bond market index fund to smooth the ride. Now, the stock market has taken a dip, or perhaps it has dropped about 20% into what is called bear market territory. Or perhaps it has even crashed further. Or you are worried it will. For the purposes of our time together, let's assume it has. Relax. Focus on the sound of my voice. Breathe in and out. In and out. In this relaxed state, let's acknowledge what you might be feeling. Perhaps you are afraid. After all, you are hearing the voices of panic all around you. Perhaps your stomach is clenched and your nerves are beginning to fray. Now allow those fears and tensions to melt away as we focus on what we know as index investors. That is, the ride may be volatile, but the market always goes up over time. Turn off all the screens, put down all the newspapers. Tune out the voices of panic, especially those in your head. Step away from the noise, gather all those fears and tensions, and on your next exhale, breathe them out. Feel your stresses release and drift away. Take a deep breath, exhale, relax. Focus only on the sound of my voice. Everything is going to be all right. The talking heads are wrong, as they always are. The stock market is not going to end. The world is not going to end. Everything is going exactly as we expected. This is all a perfectly natural part of the process. Market drops, bear markets, crashes are all to be expected. They are a perfectly natural part of the process. We have been expecting this one. We know what to do. Nothing. We do nothing. We know deep in our minds, deep in our gut, this is natural, and it will naturally pass. When it does, the market will resume its relentless rise. We simply wait. We do nothing. These periodic, expected, natural drops are what we accept as part of our wealth-building journey. They are a part of the path. They are what lead to the long-term gains we seek. They are welcome. Everything is okay. Everything is as it should be. You are going to be fine. Your money is right where it should be. You are right where you should be. This too will pass. The market will rise again. The market will fall. Then the market will go up again. It is like breathing, in and out, up and down. This is natural. This is to be expected. With each breath, you grow stronger. With each market cycle, your wealth grows stronger. This is the way of things. In your mind's eye, zoom out now. Zoom out beyond this day, this week, this month, this year, beyond this decade. Zoom out until you can see the big picture. Envision the historical trend of the index. You can see it. It grows, and then it dips, but it always recovers to new heights. Over time, it climbs and climbs and climbs. You know this. You have seen this. You are on this trajectory. Your money is growing, and you don't have to change a thing. If you are working and building your wealth, keep adding to your investments as before. You are buying them now on sale. If you are living off your portfolio and now holding bonds, here is the opportunity you have been holding those bonds for. When you rebalance your portfolio, that money flowing from those bonds into stocks is buying those stocks on sale. You are unconcerned with this temporary dip in the price of your shares. You know you still have the same number of shares as before. You still own the same piece of all those productive companies in the index. You still have all those people in all those companies, from the factory floor to the CEO, working to make you richer. And now, with this wonderful market drop, you can buy still more of those shares on sale. Perhaps you even adjust your spending to free up more money to take advantage of this wonderful opportunity. Continue to buy as much VTSAX as you can, as often as you can, and hold on to it forever. You will be fine. Stay the course. You are doing just fine. The market is fine. This is all very normal. This is all entirely expected. All that panic is only for media ratings. It is not real. The end is not here. This is but a pause in the market's relentless rise. Nothing more. Stay the course. Keep calm. Keep it simple. Keep investing. Stay invested. Ignore the noise. Let it drift away on the breeze. Now, slowly open your eyes. Notice the world around you. Everyone who loved you before the market drop still loves you. The earth is still rotating on its axis, taking us from day to night and back again. Children still laugh and play. Puppies still wag their tails. The sun still shines. The world is still a beautiful place. And you are yet one step further in your journey to financial freedom. You have met this test, and you have won. Recommit to your plan and continue confidently on your simple path to wealth. And now, go do something wonderful in this wonderful world with all your wonderful freedom.
Brad, I feel calmer already.
Yeah, I do too. That was fantastic. Just love the way that Jim frames this. Like I said before, it's so easy to let our brains just screw us up, frankly, when it comes to investing. It's so easy to buy into the hysteria. And sometimes you just need to take a step back. And yeah, I really enjoyed that.
So I think what we could do, just because, our Friday roundups are like an awesome mashup, of clips and ideas and segments that we kind of piece together to bring the episodes home. it makes it kind of hard if someone wants to go back and find the specific meditation. What do you think about maybe this week and this week only, us dropping this meditation as a standalone episode on Wednesday, just a 10-minute clip that people can go back and reference anytime they want if they want to listen to it? What do you think?
Yeah, that's super cool. Let's try it.
All right, we'll set that up. So you're listening to it now. This Wednesday, we're going to drop it as a separate, standalone, small clip, small episode. And if you want something to share with that friend or family member that is questioning your choice to stay in to do long-term investment, they're questioning your strategy on this, you can just say, it's going to be okay. Listen to Jim's meditative voice. All right. So let's go ahead and switch gears and just talk for a few minutes about the episode with Paula. We got a couple comments actually about this particular episode that I think would add some insight. So to set the frame, this past Monday, we talked about turnkey real estate investment and building a team, both of which might be part of a natural process of diversification. You know, as you start to get better at real estate, you might try to explore other ways to do it, and you might start thinking about scale and grow. Turnkey is often something that people look at as a way to get access to larger deals, maybe, or to get deals that don't require quite as much upfront work, allowing you to scale a little bit faster. Now, something to be said about that, and we were kind of parsing this in the episode with Paula, is that turnkey means different things to different people. We worked through some terminology and, the TLDR, we worked through deal syndication, which would be like accessing a mutual fund that's just specifically focused on real estate. That's the understanding that I came away with.
Yeah, that was how Paula described it. But she also described single projects, right? So you having to do the due diligence, not only on whatever company this is that's running the syndicate, but the individual projects that they're doing. So it certainly takes a lot of legwork and a lot of due diligence. Usually there are significant minimums. I know our friends, Carl and Mindy at 1500 Days and Bigger Pockets have definitely invested in these syndicates before. And I don't remember the exact amount that they put in, certainly, but I've heard other people say $25,000 minimums, $50,000, or even $100,000. So this is not for the faint at heart. And if you get that level of trust with this company, then it's something that, okay, it's going to get me access to an investment that I probably otherwise wouldn't. Let's say a 500 unit apartment complex, right? If I'm putting $100K in and a bunch of other partners, it's basically a bunch of partners getting together, pooling money and buying an apartment complex, or maybe in some cases, multiple apartment complexes or whatever it may be. Each individual deal is different, but it certainly requires a level of research that I know, frankly, I don't have that level of expertise, but I think it's something that would be interesting to learn about.
Now, and I agree with you, this is one of those, and Paul was saying this, do your due diligence. I mean, when you're talking about going into partnership and you're talking about these sums of money can straight disappear. And I know individuals, very smart, competent individuals who have thought they had this great idea for a project like this, and the money has just disappeared. So that's scary.
That's quite scary.
That'll make you lose some sleep. Consider listening to this meditation and investing in a low-cost broad-based index fund. But aside from that, real estate, there's a couple things that make it attractive, and one of them is hopefully the lack of correlation with the stock market. And as a diversification play, when the stock market goes down, if you have real estate in the background bringing in cash flow, it makes you less susceptible to volatility in the market. That is something that makes it very interesting. So if you're moving outside of deal syndication, we had someone that asked, because we didn't address this specifically, he was asking us what specifically your thoughts were on Fundrise. Now, I have no experience with Fundrise, but you have mentioned it with affection a couple times over the past 12 months or so. And I'm curious, what is your take on what they're offering and what's your experience been so far?
Yeah, maybe affection might be a little bit overstated, but it's something that I have dabbled in. I don't know a ton about them, in all fairness. I've invested somewhere, I think, around $14,000. So it's not a tiny amount of money, obviously, but it's not a life-changing amount of money by any means for me. But it was something that was interesting to me. I was trying to increase my exposure to real estate in ways that I was comfortable with. And this was before that I actually purchased the single-family rentals. I bought 2 fairly low-priced single-family rentals in the last year or so. But before that, I really did want to increase my exposure to real estate. And these kind of crowdfunding sources seemed interesting to me. So I know the way that I'm looking at it is they're basically like REITs, and that's even what they call them. I'm on my login right now. I've got the Income E-REIT, I've got the East Coast E-REIT, the Heartland, the West Coast, and I just have a couple $1,000s in each of these things. And, in all honesty, Jonathan, I wish I could give you some treatise on how amazing it is or how much I know about it, but it's basically putting money together again at a large scale and investing in numerous projects. And they're giving updates fairly constantly on, I guess, the different apartment complexes or single family homes or whatever it may be, depending on that particular investment. So I think there's something there. This is not me advocating for it necessarily, but it's something that at least is worth looking into. And unlike many of these other platforms, and this was the key for me, is at least when I invested in this, and I believe still to this date, you do not need to be an accredited investor. So that's a huge hurdle for people. Accredited investor, as I understand it, is you need to have either $1 million in liquid assets, not counting your primary residence, or you need to have had, I think it's $200,000 of income in the prior 2 years. So that is a huge hurdle. And obviously I need to check those precisely, but it's somewhere right around there if that's not it exactly. But that's a big hurdle for a lot of people. So Fundrise does not have that hurdle. And they also have, I think, $1,000 minimum investment. So for me to dabble, it was pretty low risk.
So REIT stands for Real Estate Investment Trust?
Yes.
So you're purchasing REITs through this very user-friendly platform that gives you updates on how these projects are going. You could also just purchase a REIT through a major platform like Vanguard or Fidelity or Schwab or something like that. You don't need to go through Fundrise to get access to a REIT. Is that correct?
Yeah, that's absolutely correct. Right. And if you ask me the logical follow-up, so Brad, why did you invest in Fundrise?
I love their interface. It's just so cute.
Yeah. It is very cute. But yeah, I would give you a blank stare otherwise. But it's, not exactly the most intelligent way to go through life.
I just want to be in the game, man.
Yeah.
I just want to be in the game.
Kind of want to experiment. And again, not the most intelligent way to invest, but, trying to dip my toes in here.
Okay, so breaking through some terms here. So this is a different way of interacting with REITs and investing in REITs. And when you're talking about a REIT, you're talking not just purchasing 1107 Smith Lane, but you're talking about purchasing potentially apartment complexes and large commercial spaces and things that you could never access as an individual investor, but you just own a tiny little piece, tiny little piece over here. And, but I guess there's less risk of your money walking away, hopefully.
Yeah, I mean, it's not FDIC insured, so there is always that opportunity, but you would hope based on many $1 million of venture capital for many of these companies. And you can look at financial statements, obviously. So there is maybe less risk than just finding a syndicate off the internet or maybe getting a tip from somebody on some random website.
Why are you inside this Best Buy telling me about a hot tip in real estate? What's going on here? Oh, we just think you look like someone we'd like to partner with. Well, what is it about me? Oh, okay.
You have that look, John.
You have that look, damn it. All right. So we just covered deal syndication. Then we covered Fundrise as a way to invest in REITs. And then we're a couple others. So turnkey. What does turnkey mean? So there's a couple, we were kind of splitting the difference with Paula. And one was someone just says, I'm going to do all the work for you. And then you can just purchase it at this price. And it's just turnkey. It's just good to go. Your tenants are paying the rent. Everything's set up. And Paula was saying, well, no. First of all, why are they doing that? What are the margins? What is it costing you? And honestly, if all that's freaking you out investing in real estate is just placing a tenant, then that's just a skill set you can and should cultivate. And honestly, one of the things that stresses me out the most is having to deal with old tenants that I didn't place myself because someone else's standards are different than mine. I was like, whoa, that makes sense to me.
Yeah, no, that was brilliant by Paula. And not to mention, she said there is a direct cost of finding that tenant. In many cases, it's either a half a month's rent or a month's rent that you would pay your property manager. That is what you're getting. That's the big premium you're paying in many cases for these turnkey companies. And Paula really opened my eyes to saying these turnkey companies, what they're doing, they don't necessarily have the same incentives as you. They're not looking for the long term. So when they're renovating these things, when they're flipping them in essence, many of these companies, I suspect, it's like lipstick on a pig type scenario where they just want it to look nice. They don't care if they bought the best quality materials that are going to last for 50 years. They want to sell this thing. Yeah. Right. So you have to always line up your incentives. And I think, where Paula was thinking was clearly, and it sounds like she has a history of being aware of these turnkey companies. Honestly, I don't think you and I even knew that existed, right? She's saying they find the place, they negotiate, they renovate, they even possibly find you a tenant. One thing that you and I had looked into just in passing was a company called Roofstock. And that is basically, as I understand it, just a marketplace. So they're basically vetting single family rentals. And if they get 100 that come their way, and we actually spoke with some people at Roofstock, they're not putting certainly all 100 of those on the marketplace because their reputation is based on their marketplace. So I think they said about 95% of them just get axed before they even make it. So it's about 5% are Roofstock certified to make it to this marketplace. So it seems like their incentives are slightly more aligned.
Yeah, I was thinking the same thing. I know people that love Roofstock. I haven't used it personally, but I know people that love it. And to me, that doesn't seem exactly like what Paula is describing. Rather, it is a marketplace set up end to end to give you the information you want. You know, you would probably be a little bit more hard pressed to find all the. You're trying to with the MLS, you're trying to extract the information, figure out how to make it fit your model, and then figure out how it works, and then add that. Like Roofstock's giving you as an investor all the information you would want to consider these different properties. And so they're doing that first pass. They're getting rid of the garbage. I'm not saying they're getting you to like 99 percentile, but they're making it a lot easier for you to aggregate the information to make an informed decision. To me, that seems like a reasonable approach. And then from there, it's kind of like, well, how much is this costing me, right? Because I'm sure there's just some middleman fee that they're charging you for that interface that you're interacting with.
Yeah, and Paula, I think, said something extremely, extremely smart, and we would all be well served listening to it, which is seek out third-party sources of information, okay? Don't just trust, whether you're dealing with a Roofstock, which we think there's probably a higher level of credibility than many of these turnkey companies that don't necessarily have the same incentives. But still, if you go on a site like Roofstock, which I believe to be just a marketplace, they have their inspection. They have their comps. They have their valuation analysis. Paula's point is, whether you're going through a turnkey company or any company like this, don't necessarily trust what's being put in front of you. If it costs you $300 to get an inspection of your own, and it costs you $300 to have a general contractor walk through and give you his or her list of what's wrong with this house, that's probably $600 well spent. And you're not relying on someone whose incentives don't align with yours.
And then the last part of this episode was building a team. I know you took some extensive notes. I mean, you're a remote landlord. The properties that you purchased are not in the state of Virginia. And so that means that you have to have a team. So I mean, I saw you when we were recording with her. Man, you were furiously typing, oh, yes, I need to do that. Oh, yes, I need to do that. You know, you had your to-do list, man. But I think if you're going to go from having one property, you know, and maybe it's one of those, you lived here, you moved out, it felt like it was too much trouble to list and sell it. And you just, we'll try the whole landlord thing. And maybe it was a mediocre experience. Maybe it was amazing, but you're thinking scale and grow. What does it look like to go ahead and, you know, dial this up a notch? It's going to involve a team. If you have a business and you're going to scale and grow your business, it's going to involve a team. You know, you can insert the frame that you're working with here, but scale and grow almost every time involves a team of people that are supporting that effort. And I think Paula gave us a pretty cool way of looking at it in the context of real estate.
Yeah, agreed. I think Paula had some cool examples here. And the first, and Jonathan, if I lived to 1,000, I never would have thought of this.
You might live to 1,000. I've seen those kale shakes.
But it was, look at the advertisements for homes for rent in that particular neighborhood. Look for the best written ones. Put yourself in the shoes of someone looking to rent. What would get your attention? Look for who's really just mailing it in. Who's putting some garbage descriptions, some grainy photos. That clearly is not someone you want to work with, right? She's saying if they put that little effort into the listing, how little care will they put into managing the property? Really, their biggest job is to get renters in there. And if they're doing a garbage job on the listing, that is not someone you're interested in. And she followed that up by saying, look at the listings of, let's say, so you've culled that list, right? Maybe there are 5 property managers and you see 2 or 3 of them have kind of garbage listings and 2 of them you think pass the bar. Well, jot down those listings on that day. We're recording this on September 17th. Jot down, this company has these 5, this other company has these 6, and then check back 2 or 3 weeks later and see how many of those are still available for rent. Jonathan, this is brilliant. If 5 and 6 are still available, I'm not sure they're doing such a great job. If one company has only one of those still available and the other has 6, you've just gotten a whole lot of additional information. I think that's the best framework I've ever heard for just kind of initially vetting a property manager. And then obviously you have to be comfortable with them. You need to talk with them. You need to get an understanding of what they provide. Clearly, all that stuff is crucial too. But man, what a great way to just cull that list from really no information otherwise.
And one of the things I liked is honestly how simple it is. This is a pretty simple proposition. You need a property manager. You need to learn how to vet a property manager, and you need a handyman. And you need to figure out a billing model that's going to incentivize a very responsive handyman and someone that you can work with, that you can trust, that can also be an advocate for you when you need to bring in more expensive subcontractors. Someone that can kind of make sure that you, as this rookie investor, isn't always paying top dollar, isn't always the highest paying single family investor on the block. Someone that can help you to do competitive market bids on projects that you need to have accomplished. Have an advocate. And so that involves having someone on your team that's incentivized to watch out for you when you have to bring in these other one-off type contractors. I think there was a lot of really valuable information there.
Yeah, agreed. And just in summation here, this quote from Paula, I could not read. Passive income is not a euphemism for free money. Passive income is front-loading the workload so you can enjoy the rewards down the road. That says it all.
All right. Well, I wanted to switch gears here and take a couple minutes and just discuss some very interesting information that we got when we took a survey. So we posted a survey in our Facebook group, 50,000 people. We actually got 1,500 responses. And as a team, we've been kind of going through some of that information and figuring out how we can best serve our community with that. And there were 2 patterns that came apparent. One of the things that people love about the show is they feel, or they were expressing, that it reaches them where they are. And many times I think I kind of sense this pattern, this theme, that I think many of us feel stuck just for various reasons. Like either life hasn't turned out exactly the way we thought it was going to turn out. The opportunities haven't opened up to us the way we thought they would. The job market hasn't been exactly what we thought it would be. Our education didn't take us exactly where we thought it could go. Our creative side has kind of been like bored out of us, and we just don't really have room to explore that. Our relationships, we haven't been able to lean into them to say, whatever. Like I've started to see a little bit of a pattern there. People expressing that they felt stuck, in the show in many ways has been a conduit for them to feel like they're moving forward again. That's really encouraging. The other piece of information, MK, actually want to bring this up to talk to you about, is the actual sense of community. Now, we've been a crowdsourced show, and the heart of this has always been the community, but I feel like we still have some work to do based on the data that came back in the survey.
Yeah, so there was definitely a lot of great feedback about our local groups and local meetups, which was really great to hear. But it turns out that only 35% of the audience that responded feels like they can share their FI goals with someone else. So that was really sad to see, to think that 65% of our audience feels that isolation, feels like they can't talk to somebody in their household, in their family, in their group of friends about their financial independence goals, which is such a big part of their life. So that was something that really stuck out that we want to try to address quickly, because 65% of you want to be able to tell other people about this.
So I think, Brad, what I'd like to do with this information, I'm actually going to, I think the heart of this is finding out what people are struggling with, what are they stuck on, and then, creating resources to serve them where they are. And so what I was thinking we could do on this episode is we'll just set up a short code, choosefy.com/stuck. It'll redirect in the short term just to a Facebook post that we're going to have to our audience. Maybe you didn't even know we had a survey. This is the first you're hearing about it. On this thread, just put a reply in there if you're interested. Just put a reply that lets us know, what is it that you're struggling with this year? Where are you stuck? What sort of information would be the most valuable that would serve you where you are? We're crowdsourcing information, but we're also crowdsourcing struggles, things that you're struggling with. And so if there's something that we can be doing better, Brad, I think this would be a fundamental place to start.
Yeah, I love this. Hopefully everybody out there, if there's something you're stuck on, send it in. That's going to help us inform the future of what we do here at ChooseFI. And I think it's really important. So like Jonathan said, choosefy.com/stuck.
We'll try that in a couple different formats. So if you go to that website, it's going to redirect you to Facebook. If you're not on Facebook and you want to send us an email, if you go to the show notes for today's episode, there'll be a form where you can just send us an email, answering that exact same question. But we want to aggregate your information. And I think there's something cool here that as a community, we can bring these ideas together and we can move forward together. So, MK, I wanted to take just a few minutes on this note and actually give a shout out. What do you got for us this week?
Today, we have a shout out from Eva. She gave a 40th birthday gift to herself by paying off her student loans.
Whoa.
So Eva wrote that on the eve of her 40th birthday, she did something a little crazy. Instead of treating herself to a fancy gift or fabulous vacation, she paid off her student loan. She had been paying the minimum amount for 14 years. She actually used more colorful language there. 14 years. So let that sink in. So she writes, I kept telling myself I'd pay it off, but the interest was so low, which sucked me in. When I added up all of the money I flushed down the drain, it makes me sick. If you're a young person in this group or a parent of a kid entering college, please research the perils of student loans before you take one out. Without a loan, I would have never been able to go to college, but it was so easy to take out the debt back then, thinking you'd be able to pay it back when you get out. This group has been encouraging to follow, and a lot of the reason I decided to write a fat check for my 40th to get one step closer to being debt-free. Personal note, when you pay the final payment, there's no fanfare. I was secretly hoping a screen would pop up saying, congrats, you did it, but that didn't happen. I had to contact them to get this letter. And you better believe I did the happy dance. And Eva actually posted the letter that she finally received saying, your loan is paid off. So happy that you did that happy dance, Eva, and we will be doing that happy dance with you. Happy birthday.
Huge congratulations to you, Eva, and on all of your progress. And hopefully you got some fanfare in the Facebook group with that announcement as well. So MK, we talked about community. Let's go ahead and bring this back and talk about our local groups. So we have local groups all over the world, well over 200 now. It might even be approaching 300 local groups all around the world, every single major city. But new local groups are popping up every single week, and we want to acknowledge those and also acknowledge really cool events going on inside the community. What do you have for us?
So this week, we have several local groups that have really taken up the mantle with Junior Achievement, who we did an episode with a few weeks ago. So Sean from Canada said that the Alberta Choosify local group was invited to attend the Shifting Your Financial course, a non-boring personal finance event. So on September 28th, they're going to have this event, and all the proceeds are going to be donated to Junior Achievement Northern Alberta, which is really exciting. And then the Phoenix local group is also attending a Junior Achievement Open House on September 25th. So we have two of our groups really taking the charge with helping out with Junior Achievement, which is awesome. And then the Seattle local group is actually hosting an event with Paul Merriman, who was on episode 130 on September 28th. So it's really exciting to see that the local groups are taking action from what we have here on the episodes.
That is amazing. And we, at this past year's FinCon, we got the opportunity to speak with Rick Ferry, Brad, and I was kind of catching you up. I don't think you weren't there, or you weren't able to make that meeting. But Rick Ferry, who works with the Bogleheads and actually started a Boglehead podcast, was looking for ways to partner with us as well. And they have a nonprofit, which the namesake is John Bogle, the father of index funds. And, there's a lot of mission alignment there as well. And so I think there's a lot of overlap, and we're going to probably invite him on the show in the near future. But one of the things that he was mentioning is like pursuing financial independence doesn't end at any particular point. It's a life's journey. So at one point you're in the accumulation phase, right? And you're trying to get to this number. And then at some point you're in the decumulation phase, but it all requires intentionality. You need to keep your eyes on it. And so, obviously with the Bogleheads, they're reaching an older audience. There's a lot of insight that we can bring back in that would really be beneficial for our community. So that's something that we're teeing up for probably early next year.
Yeah, Jonathan, that is super cool. Obviously, there's a lot of synergies there with Boglehead. So very excited to see where that goes. And MK, I just wanted to mention the local groups. People can find them at choosify.com/local.
All right. Well, unfortunately, that's going to bring this episode to a close. Now, as you know, we like to finish every episode by doing a drawing for a copy of a book that we have found useful. And actually, now we're actually offering our book, Choosify, Your Blueprint to Financial Independence. It's available for pre-sale now. You can find it at choosify.com/book, or it's available anywhere books are sold starting on October 1st. You could also enter to win the drawing. We'd love to enter you in a drawing to win a free copy. To do that, all you need to do is just go to choosify.com/iTunes, follow the instructions there, leave us a short written review, and then send us an email to feedback@choosify.com letting us know that you left a review, what screen name you left it under. We give away one book for every 5 written reviews that we get, and we announce the winner on the Friday Roundup. MK, how many winners do we have today?
Well, guys, today we have one winner, Benjamin. So he writes, in a world. Yes, I find myself saying the intro to the hot seat along with the crazy deep voice guy. I get so excited to see what step I can use in this week's episode to further along my path to FI. After years of slowly saving and just holding my money in my account with little to no return, I am finally getting my plan together. Thanks to Choosify, I have my plan going forward and look forward to showing my second generation FIRE kids, I'm looking at you, Jonathan, how to have a much easier go of it. thanks for bringing us so much great info.
Thank you so much for being on this journey with us. It lights us up to get the opportunity and the privilege to be with you twice a week. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.